I see a lot of students here, so it's a very familiar ground for me because we give lectures to students mostly. And Department of Economics, so I'll be talking something about financing of the rural sector and the rural scenario in India today. I'm not going to be, I didn't expect, I didn't know what kind of audience I'm going to face. So I did not do much of technical stuff here. But I think you will all get the message of what I'm going to say. I mean, I'm not going to be very technical about lenders' hypothesis and risk and uncertainty and interest rates and things like that, which is rather boring. Instead of that, what I'm planning to do is give a historical perspective on this. This is an idea that came to me long back. You know, actually, when we were looking at the great hue and cry about microfinance in our country, and the fact that microfinance seems to be the silver bullet that will bring the Indian rural population out of poverty, and that essentially that this microfinance was the brainchild of, you know, who was the brainchild of microfinance? Anybody? Somebody from Bangladesh? Oh, yes, okay. The Grameen Bank concept. But I see that you don't know his name. It's okay, you can go and look up his name. But what struck me about this whole idea of microfinance was that it sounded familiar, because when I was doing research in University of Hamburg, we had an occasion to talk a lot about the Indian situation and Indian problems of economic development. And it turns out that a little bit of research reveals that this is not a new concept. And that's what I'm trying to bring forth to you today. Here's my address. You can interact with me later after the talk if you are interested in doing research, especially students of economics, students of economic history who would be interested in looking at some of these things. Let's look at first the problems faced by the rural credit markets in countries like ours. What is the problem of rural credit in this country? The reason why we are talking about this is there's a lot of talk about what is known as inclusive growth in this country. You all know that India is posting very high rates of growth, or was posting at least higher rates of growth than the famous Hindu rate of growth of 3% per annum, which existed before the liberalization period. After 1990s, we liberalized, and then we have now got a rate of growth which exceeds 5%. But what is this growth all about, and to whom does this benefit of growth go to, is a very important question. The question of distribution of wealth in this country. You all know that India is a very rich country, but it has got very poor people in it. So there is a paradox here of a rich country with poor people, and the reason is that the wealth is not very properly distributed. One of the most important things about money is the information on the borrower. If you have good credit-worthy information about who borrows money, it's easier for you to lend money to such people. What do we mean by this information? Information is, first of all, the credit-worthiness of a borrower. How credit-worthy is he? And what does that mean? It means information about how this person is going to use his money and how he is going to repay you. If you have this kind of an information, then it becomes much easier for you to decide whether you would lend money to this borrower or not, correct? One way of tiding over the risks is having collaterals. You know, having to ask for a collateral, a guarantee, a collateral, that in the event of a default of a loan, then you have a collateral that you can then appropriate and then use that to repay your loan. So having collaterals is a very important aspect of lending and borrowing, correct? Okay. The problem is in the rural sectors. Now take this model to the rural sector. and look at the information on the borrower by formal credit institutions. Now, the formal credit institutions have very little information about the borrowers in the rural sector, who are mostly farmers or tenants who are working on farms of rich landlords, etc. Our tenancy system is still very strong in our country. Remember, you're an urban audience, but more than 70% is in the rural sector here in our country. We are still very much an agrarian society. We are still very much based on the agriculture in this country. And it is vital that we get good agricultural credit going in this country. And that's one of the biggest bottlenecks that we face. Obviously, now these peasants, these farmers, these small farmers, large farmers, what kind of information can a credit institution have on these people, right? It is quite difficult and, in fact, expensive to get complete information on the creditworthiness of such people. Secondly, what kind of collateral can they offer? A cow, a buffalo, moving collaterals, collaterals that can move, collaterals that cannot be easily identified, collaterals that change over time. You know, it's not easy to have such things as collaterals. In fact, Germany faced very similar problems, but not now. It faced it in the late 17th, 18th century, 1774, 1776, 1800s. This German population was very similar to what the Indian population is today in terms of inadequacy of large incomes for people to come out of poverty. And they had the same problems of collaterals. They had the same problems of formal credit information on borrowers. However, whenever there is this kind of a vacuum where formal credit institutions cannot get this kind of information, there is a risk in lending out to such institutions. How do you hedge against such risks? Well, as I said, collaterals are not very easily to come by in the rural sector, unlike in the urban sector. The normal economic theory would tell you that a rational lender would charge a premium on the interest which covers the risk, right? So risky businesses will be given, and money will be lent out for risky businesses at a premium because they are risk prone, right? However, again, the Indian rural sector is unable to cater to higher rates of interest. They simply do not have the wherewithal to be able to borrow at higher rates of interest from these formal credit institutions, or so says our government, right? So therefore, what the government does is, in our country, puts a cap on the interest rates. You cannot raise the rate of interest to the rural sector beyond this. What do you have then left? You have a situation where there are two things that happen. There's an adverse selection process that can happen. There's a moral hazard process that happens here. One of the things is that if banks are not allowed to hedge against risks and also have a cap on interest rates, what they will do is they will certainly lend to the rural sector, but they will ration out the lending. Only a certain quota of money can be then put aside for the rural sector. So this rationing out gives a situation where the total amount of money lent to the rural sector by formal credit institutions is simply inadequate for the rural sector needs. That is the situation of formal credit systems. So that's why I said cap on interest rates leads to rationing of credit, correct? Indira Gandhi tried to nationalize, by nationalizing banks in the 1960s. What do we mean by nationalizing banks? The idea is that you change the property rights regime of the banks. Now banks are controlled by government directives, right? Instead of private banks lending to people from whom they think that they can make profitable ventures, The government takes over this condition and then directs banks to lend to the rural sector. It is called priority lending. And we know that all national banks have an obligation to lend to the rural sector, and it's called the priority sector. It was called the priority sector. However, the problem was large amounts of this rural lending turned into non-performing assets for banks. The reasons: cannot completely monitor the loans that were given out to these people. This is a moral hazard problem. The problem of how much of this credit that is being taken by the rural sector is actually being used for productive use, and how much goes into consumption credit becomes very difficult for banks to monitor. Second thing is that you see, if you're charging a higher rates of interest, those who are likely to default will take loans, and those who are obligated to repay this money, if you charge a high rate of interest, will simply not be able to afford to do this. So that's called an adverse selection process. That also works in these kind of situations. That's why governments try to put a cap on interest rates. Did you understand what I'm saying? Loans are written off by governments. Government waives loans in such situations, and then this creates, again, perverse incentives. If borrowers know that their loans will be eventually written off by governments, then they'll tend to borrow more and default, right? That's what an economist looks at, you know. That's the difference between an economist and an activist. And an activist says, oh, you must lend to all the poor people. What will they do? But then, you know, this is the kind of, I tell you a story of a person, two people were fishing. And one was a poor man with a stick, and he didn't have a very good fishing rod. The other person was a German who had one of the finest of the technologies to fish. And both were fishing in the same lake. And of course, Mr. German caught lots of fish. And this poor man was, because of the poor technology that he had, caught just a few fish. And so the Mr. German took a lot of pity on this fellow and said, why don't you take a few of my fish for your family? He was very grateful. He said, thank you, sir. And then he went away. The next day, again, he found that the man is sitting there trying to fish, and our friend was also fishing, and he shared a part of his wealth with this person. The third day, he was there, but he didn't have a fishing rod with him. He was just sitting there. And the German said, now, why do you not bring your fishing rod? He said, well, you're going to give me fish anyway, so why should I even bother trying to fish? Right? That is the perverse incentive that economists talk about. This is it's a very natural phenomena that happens. That's why we say that aid from developed nations to developing nations can fall into this kind of a category where, you know, developing nations simply wait for the money to come and don't do anything else about it. The alternative to the rural households is dependence on money lenders. And we know that the Mahajans, the money lenders, lend. The money lenders are at a great advantage compared to formal credit institutions in our country. Why? The reason being that a money lender is part of the village. The money lender has intimate knowledge about the goings-on in a village. The money lender has good information about how this money is being used by the village people. So therefore, he doesn't have this problem of monitoring this. The second thing that a money lender does is that unlike a formal institution where the money has to be repaid at a certain time, at a certain way, in a certain style, the money lender is far more open to a flexible system of repayment. It doesn't have to be in cash. It could be in kind. It could be in terms of labor services that they offer to the money lender. And you know, this is how bonded labor starts becoming a way. In other words, the money lender is really not worried about whether this guy is going to use it for productive means, or is going to use it for consumption purposes, or is going to use it to pay for the wedding of his daughter in the village. As long as he is able to get this money back in several different forms, in several different ways. And he charges exorbitant rates of interest, 30, 40%, sometimes 35%. But that rate of interest is not a formal rate of interest like in a formal institution where you have to pay the money back. Here you can pay it back by various other means. Therefore, now, in that situation, microfinance was touted as one of the greatest innovations in this century, and that the Grameen Bank model suddenly seems to be the way out of this kind of a problem, where the formal credit institutions' volume of credit is not completely adequate, and the rural sector is so dependent on money lenders, and then therefore they are unable to really get out of the problem of poverty and bondedness of their labor. And you know the Grameen Bank model and things like that were. There's also the concept that was evolved out of the microfinance ideas that were in this in the last 10, 15, 20 years, called the self-help groups in India. And today, a lot of research, especially in my School of Economics, many of my MPhil students and PhD students are looking at self-help groups in various parts of the country to assess how good these self-help groups are. But these self-help groups and microfinance was kind of was looked at as something completely new and innovative, right? Now, is it a new idea stemming from the concept of Grameen Bank is the question I ask. So here, let's look at some history. That's where I take you now, back into the history. Do you know that every developed country in the world today has had its own history of microfinance? That's the first thing you should learn, that microfinance is not something very new. It was already there in existence for the last 2 centuries. And every developed country, all we have to do is actually go back into time, into history, and look at how. See, the question we should ask ourselves is, if England, if at the time of Charles Dickens writing his Oliver Twist, you can see the kind of England that he described was very much similar to the kind of India that we have today. Wretched forms of people, corruption, robbery, thievery, and you know, the kind of things that happened in England were appalling. Is the same case with many of the European countries. In the 1700s and the 1800s, there was massive poverty in Europe. The question we ask is, how did they get out of it, and how can we learn lessons from that? That's the question that we need to know, right? That's why I'm asking this question here. The one important thing was that many of the kind of institutions for credit or money, you see, money is at the center of things. And when you don't have money, then you have to borrow non-existent money, which is credit, basically. You know, you are taking, and this is the Schumpeterian hypothesis that credit is very important for financing innovations and entrepreneurship. And that is why credit becomes such an important issue. They were all very small scale and very informal kind of institutions that evolved in Europe in the beginnings of the 18th and 1800s and late 1700s. There was a tremendous increase in poverty in the 16th century in Europe, right? Microfinance in Germany has very old roots, and there were 3 main roots of microfinance in Germany that we have to look at. One was the community-based savings funds, which was organized informally through communities in trying to incentivize them to mobilize their savings and pool their savings together in order to do something. This is a concept that started in Germany, but it had 2 kinds of movements, both one as a credit cooperatives in the rural sector and in the urban sectors. The first thrift society was established in Hamburg in 1778. And the first communal savings fund in 1801. Communal savings fund, you know. It sounds very familiar now to us that we are talking about self-help groups and the so-called microfinance. But it had its origins as far back as this in Germany. After the hunger years of 1846-47, there was a huge, massive kind of a famine and hunger in Europe. A person called Raiffeisen, Alfred Raiffeisen, created rural savings and credit cooperatives. But how did he do it? First, he approached wealthy Germans and asked for charity. I don't know whether I... Today, it was originally called credit associations, and today, of course, it's the Raiffeisen Bank that still operates in Germany even today, but its whole structure has changed. But how did this structure come about in the beginning is what I am interested in. What they did was they had these locally anchored savings banks and cooperative banks, which were very small in size, and accepted savings to be deposited and guaranteed microcredits to the own community and nowhere else. You know, they were very small such systems. The most important economic principle that drove these tiny institutions of microcredit in Germany was the principles of self-help. Very interesting, old concept, self-help. It's not something new today. Individual responsibility and self-governance, an extremely important ingredient, all three of which are lacking in this country at the present. I'll come to that in a little while, you know.